What is happening, investors? It is your boy Jack. I am not a financial advisor, and today I'm uploading two videos, okay? Earlier on I uploaded a video about penny stocks, and after uploading that video, Carnival's Q2 earnings came to my attention. Now, I have not uploaded a standalone video on Carnival in over 2 months. I mean, back when I was last speaking about these guys, they were $8 a share, $9 a share. Right now, they're at about $19 a share, and their Q2 earnings just came out. And that is what today's video is all about. We're going to be having a nice look into Carnival's Q2 earnings. We're going to see how things went, what we can expect to happen going forwards. We're going to obviously have a look at the cruise line industry as a whole, how the future is looking compared to what I believed a couple of months ago. There is so much uncertainty surrounding cruise line stocks right now. They're deemed to be one of the most exciting industries, one of the most exciting sectors by many investors right now. They're one of everybody's favorite high risk, high return plays. And a couple of months ago, Carnival were one of the companies I was looking at the absolute most. I've told the story before, but the second time they hit $8 a share, I had a considerable amount of shares on my phone ready to buy. I never pulled the trigger, and I'm kicking myself. So guys, if you enjoyed the video, please drop it a like. It helps me out absolutely massively. It helps the videos get seen by more people. Drop me a comment down below with your thoughts on Carnival, and especially drop me a comment down below if you own them and what price you've got in at. And please do subscribe if you're new around here, guys. We're very close to hitting 8,000 subs, so I would really appreciate if we could get over that mark today. So with that being said, guys, there's a lot to cover. Let's get straight into the Q2 earnings. What is important to keep in mind, okay, is that these Q2 earnings were expected to be absolutely terrible. So it's not going to be a massive shock to investors, but they still are very bad. So US GAAP net loss of $4.4 billion or $6.07 diluted EPS for the second quarter of 2020. The second quarter of 2020 adjusted net loss of $2.4 billion or $3.30 adjusted EPS. I mean, this is absolutely horrible, guys. You don't even need me to tell you that. Total revenues for the second quarter of 2020 were $0.7 billion, lower than the $4.8 billion in the prior year. The company's guest cruise operations have been in pause for a majority of the second quarter. In addition, the company is unable to definitively predict when it will return to normal operations, and this is important. So I remember initially cruises were expected to go, at least in some capacity, in June or July. It's now June and cruises aren't going. Norwegian Cruise Lines postponed their cruise date. Carnival, Royal Caribbean and Norwegian Cruise Lines are all under pressure after Norwegian extends its suspension for cruising until September 30th. How many more extended suspensions are we going to see before there is any cruises going again? This is by no means a guarantee that cruises will even go again after September 30th. And more than likely, all of these cruises are going to completely miss out on all revenue of the summer months, which obviously are some of these companies' best months year round. And look at this, guys, okay? Carnival's second quarter revenue dives, we all know that, as it prepares to sell off ships. That is one of the worst headlines we could read, especially if you are an investor. Carnival reveals a massive second quarter loss and steps to sell off a half dozen cruise ships in an effort to keep itself buoyed amid the Roni pandemic. So a little bit more on the ships that they're selling. They're playing it off well, okay? They're saying it's in connection with its capacity optimization strategy. The company intends to accelerate the removal of ships in fiscal 2020, which were previously expected to be sold over the ensuing years. So basically they're saying they were going to sell these ships anyway, they're just going to do it a little bit quicker now. Whatever way you try to spin it, I don't think it can ever be argued that it's a good thing to have to sell these ships before they wanted to initially. It's not like they have a choice, it's not a luxury. They don't want to sell these ships. They have to do so to give themselves the best chance of survivability. Now, the second quarter 2020 ended with $7.6 billion of available liquidity, and the company expects to further enhance future liquidity, including through refinancing scheduled debt maturities. In addition, the company has $8.8 billion of committed export credit facilities that are available to fund ship deliveries originally planned through 2023. So essentially, they do still have a very considerable amount of cash, but keep in mind a lot of this is debt, a lot of this was borrowed. Do you remember this when Carnival paid steep rates for nearly $6 billion in new debt? So they're ending this quarter with $7.6 billion of equity, and they took on $6 billion of that at high interest rates. If you don't remember what this entailed, there was $4 billion of senior secured notes with a coupon of 11.5% and $1.75 billion in convertible notes at 5.75%, and that debt matures in 2023. So the available liquidity is predominantly debt. And something to take into account, total customer deposits balance at May 31st, 2020 was $2.9 billion, including $475 million related to cruises during the second half of 2020. Right now, nobody knows if there will be any cruises in the second half of 2020. Now, in regards to current bookings, as of May 31st, 2020, approximately half of guests affected have requested cash refunds despite substantially reduced marketing and selling spend. The company is seeing growing demand for new bookings for 2021. And for the 6 weeks ending May 31st, 2020, approximately 2/3 of 2021 bookings were new bookings. Booking volumes for the 6 weeks ending May 31st were running meaningfully behind the prior year. However, the company did see an improvement in booking volumes. So Carnival is going to have to sell 6 ships. There are currently 62 of the company's ships in their final expected pause location. So that is a decent portion of these ships that they have to sell. And while we're down here, we'll speak about optimizing the pause in guest operations. So essentially how they are reducing spending. So reduce crew payroll, food, fuel, insurance and port charges, all of the standard stuff. Marketing and selling, again, standard all across any business in the world right now. Layoffs, furloughs, reduced work weeks and salary and benefits, and a hiring freeze. So just what everybody else is doing. The company has reduced capital expenditures and estimates 300 million of non-new build capital expenditures during the second half of 2020, which largely consists of previously committed expenditures. Not the most significant figure in the world, but good nonetheless. Okay, so how have Carnival maximized liquidity? We just spoke about the 6 billion of high interest debt. They fully drew down its 3 billion multi-currency revolving credit facility. They did qualify for a government commercial paper program providing over $700 million. They early settled outstanding derivatives, which is good to be able to do, receiving proceeds of $220 million. And they were able to extend the 166 million euro denominated bank loan, originally maturing in 2020, to March 2021. To me right now, 2021 to 2023 is looking like a scary time. March 2021 is not that far away. Now, the market's been open for close to an hour, and Carnival is actually currently up a little bit. They opened up down about 4.5%, and they've gone back up since. So Q2 earnings didn't really deter many people. It hasn't had the biggest impact. I do think though it should have had a bigger impact than it did. I know we expected it to be bad, but it was very bad. And again, this just makes it clear how bad it is. The company posted an adjusted loss of 2.4 billion versus earnings of 457 million in the last year's same quarter. Analysts had been looking for a loss of 152 a share compared to 330 a share. That's not good. So Norwegian is looking terrible, okay? They've had to delay everything till at least October. It's only a matter of time before Carnival and Royal Caribbean have to do the same. I mean, Norwegian aren't doing this for the fun of it. They're doing it because they absolutely have to. And the other cruise lines will have to follow suit. So now there's a chance we will see no cruises at all worldwide until the last quarter of this year. And that is now our best case scenario. That is an ugly best case scenario considering the amount of debt these companies have. So I mean, they're doing what they can. They're doing everything as right as they can. But it's still a terrible situation. Just because they are cutting expenditures, just because they are docking their ships, just because they are selling ships faster than they could have, it doesn't mean that it's a good thing. Now, just speaking from a practical point of view again, because it's always been known that any of these cruise line stocks are a high risk, high reward play. On the 5-year chart, Carnival's still down over 70% from its highs. On the 1-year chart, still down 63%. And the thing about that is they're actually up 140% from their very lows. If you're investing in Carnival, you're investing because you think they're a growth stock, especially when we were all buying in the single digits, $8, $9. If you think they're a growth stock, let's just take a step back for a moment, okay? The recent highs, let's just say they were at $50. And now, to make the numbers easy, we're at $20. I don't see a world where Carnival can possibly hit $50 in the next couple of years. I really don't see how that is expected to happen. Here, things were going fantastically. They were at full capacities. They were doing better than ever. It was lovely. Now, there's no cruises. They are absolutely riddled with debt. And they have less ships for when times are good again. It does not make any sense. I know a few people will ask me, would I invest in them at this price, around the $20 price mark? And the simple answer is no. If I'm investing in a high risk company that very much so has the chance to go bankrupt and I could lose my entire investment, why would I do that if I believe that, you know, potentially in the next few years they might get to $40 a share? There are much better options out there, in my mind at the very least. Now, don't get me wrong, I do still completely understand the appeal. I'm only speaking about the next few years, you know, the next 2 or 3 years maybe we could see $40 or so. Maybe in the next 10 years we're going to see $100. The thing is, there is lots of other companies out there who are much safer, with much better balance sheets, with better fundamentals that could give back that same amount of return with essentially zero risk of bankruptcy. I mean, I've been looking at these guys since they were a $40+ company. I saw them hit $8 on 2 separate occasions and contemplated buying on both of those occasions and still didn't because the risk to reward ratio at that period of time made no sense to me. Now it makes even less sense. The company's gone up close to 150% and the short-term prospects are worse than they were 2 months ago when I was heavily considered buying. So personally for me, at this price, I would have zero appeal in Carnival whatsoever. Genuinely, I don't think I would even consider investing in these guys unless I was to see somewhere below $12 again. At this stage, with the amount of emotion involved with Carnival to an awful lot of investors, that may well never happen again, and I hope it doesn't happen again. You know, I really hope that Carnival does go to the moon and proves me wrong. I hope to be on a Carnival cruise next year thinking, you know what? I should have bought shares in these guys. They would have basically paid for this cruise for free. I really do want to see Carnival go well, but that is not necessarily a reason to invest. Emotionally, I am attached to this company. I love this company. They were one of the first companies who really piqued my interest, but logistically, it does not make enough sense to me, especially after looking through this Q2 report. So guys, I do hope that you were able to enjoy today's video and take something away from it. And I'm not trying to rain on any of you Carnival Investors parades, because I know a lot of you guys did get in at $8, $9, $10 and are still in a fantastic position. And if I was in at $8, $9, $10, I would probably have a somewhat different mindset. I wouldn't be selling anyway. I wouldn't be panicking, I'll put it that way. I just want you all to be fully aware of the risks and what is going on with Carnival. That's the reason I'm making this video. I'm not a financial advisor. You know, always form your own thoughts and opinions. Go out and read the Q2 yourself. Go out and do whatever research you can yourself. Form your own opinions and decide what you believe. Hindsight is 20/20. If I knew all of this was going to happen, I would have taken a stab at the $8 a share mark. But I didn't know it was going to happen. Nobody did. Anyway guys, I hope you all have an absolutely fantastic day. Please do subscribe if you're new around here. We are trying to get to that 8,000 mark and ultimately 10,000. I appreciate you all so much. Have a fantastic day. Peace.